Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. I'm Ruchira and with me is our in-house expert Dhirendra Kumar, and today's topic is something that a lot of retirees want to know about: fixed deposits or debt funds. Which is better in retirement? So welcome, Dhirendra.
Thank you.
Let's dive right in. Why is this comparison important in retirement, first of all?
No, this comparison is important because deposit is something people are used to.
Yeah.
They have been doing it for 50 years. And in India, ever since the nationalization of leading banks in the country and the post office deposits, which is also a very substantial, retirees, it's a magnet for retirees' money because of post office MIP and, senior citizen savings scheme or the term deposit, because of which, they're used to. That is a safe haven. Mutual funds are relatively new. Mutual funds are relatively new not because the mutual fund industry is very, the mutual fund industry is very old. The modern open-end debt fund, which started in 97, 98, and that too, with great innovation, and it was practically difficult, impossible to run an open-end fund, open-end debt fund at that point. So people are not used to it. Moreover, when it comes to fixed income, people want guaranteed income, and in India, most fixed income schemes coming from public sector banks or the post office schemes is perceived to be absolutely risk-free, and understandably, it is.
Now, coming to the debt funds, where do they score better as compared to FDs?
Everything. Little better return, tax efficiency, and seamless liquidity. You invest in, you make any deposit, it comes with a term.
Yeah.
And there is always a penalty for withdrawing earlier. Open-end debt fund, put your money, take out a little bit tomorrow, put again day after. There is absolutely no penalty on withdrawal. So easy liquidity, little better return. If I do a 3-year deposit as compared to a fund with a 3-year maturity, I just might end up, making 0.5% to 75 basis points more on that. Third is, tax efficiency. If you make a deposit and you don't take out any return, it earns 8% return. Just for example, so that 8% that you have earned, even if you don't take out, is taxable.
Okay.
You put your money in a bank short-term debt fund, it earns 8%. You are not liable for any taxes till you withdraw it. It's a ultimate tax deferral. So most Indian investors, most reasonably okay people, they do these deposits for a very, very long term. You will come across 5-year term deposit, but people will be rolling it 4 times, and that actually is a 20-year deposit. If you do a 20-year deposit, all your intermittent returns has been taxable, and there will be a TDS on that. In case of mutual fund, everything will keep accumulating and you are not liable for any taxes till you realize it.
Yeah. So you're saying that even after the indexation benefit gone, debt funds score better than FDs?
Oh, absolutely. Simply because of it is a tax deferral. You are not liable for taxes till you realize it. Deposits, you are liable for all the intermittent income.
Right. But aren't debt funds risky as well?
Little risky, but very little risky. Because a debt fund is a collection of bonds.
Yeah.
And substantial part of most such debt funds is either government bonds or public sector banks certificate of deposits, CDs primarily, or bank deposit itself. There could be some part which could be rated corporate bonds. But rated corporate bonds, mutual funds have taken, has been very risk averse ever since, 4-5 years back. There was a debacle with 2-3 companies, big companies defaulting, which had high rating. So most mutual funds actually invest in AA and plus securities, and remaining money is there. So one, that you will have little risk, credit risk of a certain kind. And then there is another risk in debt mutual fund, that when interest rates go up, bond prices fall. When bond prices fall, people get very upset. But then that is a temporary thing. It is the scale, the magnitude of such decline is of a kind like, it will be 3 weeks gains gone, or something like that, 1%, 0.5%, 2%. It is never like equity, that 40% of your money gone and how long it will take to recover. Because unlike equity, the components of debt or the component of a debt bond is frozen. When you invest in a bond, there are two things which is absolutely frozen in arithmetic. That how long, what is the maturity of this bond? So if there is a 7-year maturity bond, every day that passes, the maturity gets reduced by a, so you exactly know when you will get your money back. Second is, what is the coupon of this? How much interest rate you will get on this bond? Third thing, which has become mandatory, that what is the credit rating of this fund? What is the quality of this fund? And based on that quality, you know that whether you are likely to get this money or not. If it is from Government of India, you are assured that, okay, you'll get your money back definitely. If it is a AAA, if it's a Tata company, if it is that company, if it's a Birla company, people tend to, think that, okay, and then AA and above is considered to be reasonably foolproof, reasonably fail-safe. So this is that is all there to it. These are the only three things, and something going up, interest rate goes down, and you will continue to keep getting this coupon over time. So it's a very arithmetical adjustment of the bond prices that happens, and it is fairly predictable. So you get predictable return with little bit of risk, and the risk is nothing as when compared with the risk of equities.
Okay. For someone who wants a regular income in retirement, what would be your advice? FDs or debt funds?
My advice to anyone who is looking at seeking income from in the retirement from their capital is very careful analysis. If you are definitely dependent on your investments, because people can have multiple streams of income in their retirement. You might be getting some pension, you need some supplementary income from your investment, or you might be earning some rental income, or your need can actually go down quite dramatically if your family is being run by your children and you live in a joint family. So it entirely depends on your context. But I would say that it requires careful planning, and whether you should have all your money, substantial part of your money, or a good amount of money, or essential amount of money in senior citizen savings scheme or post office MIP is one thing. Second is, if it's a supplementary income, then where that money should be. If it is very, it's working on a tight budget, you need something like 25,000 rupees a month, and you have 50 lakh rupees capital only, and you definitely need these 25,000 rupees a month. Then you need very careful planning, and you also need to take a very measured risk. Because if you don't take that measured risk, you will start eating into your capital. That might require, taking a 40% allocation to equity, 60% to debt. 60% debt can be, a part of it could be in senior citizen savings scheme. Take your whole money, take a holistic view of, do a holistic planning of your money. Of that 50 lakh rupees, if 60% has to be invested in fixed income, then consider senior citizen savings scheme as part of that 60%. Take, and that 40% which will go in equity, you should not touch it, so that it will get time to appreciate, and you will eat consuming capital from this 60%. From post office MIP, you will get something every month. From senior citizen savings scheme, you will get something quarterly every quarter. And the equity will keep growing. So in 5-6 years time, when your capital will remain, the 60% which will remain capital, you can replenish it from the appreciation that has happened here. I'm just giving you for this example for illustrative purpose. But this is a principle which everybody should follow, depending on his, essential need for income from their investments.
All right, now one last question. Whether investing in FDs or debt funds, what are those common mistakes that investors tend to make and should be avoiding?
Make sure that you are not taking a risk with your fixed income investment. That you will not, people go for a little higher return, and because of that, their capital never returns. They lose their capital. So don't get greedy about it. Be very careful about it, and in fact, if you are getting little higher return, you should not fall for it. Because in fixed income arena, every higher return comes with unusual risk, disproportionate risk of capital. So that's one. Second is that, you need an optimum mix of, there is nothing like, people will have their PPF account, and the return from PPF will be tax-free, and that is a worthwhile thing to hold. You need a mix of it. It is not one of it. If you are deriving income from senior citizen savings scheme, your public provident fund accumulation, and post office MIP, Then consider, other fixed income funds, because fixed income fund or a hybrid fund can be a nice way of making sure that your capital is rising. And here is something from which you will derive income and you will be assured of it. It gives you a great consolation that whatever may happen, this is something which is assured. So in India, you have this great avenue of, these fixed income alternatives, bank deposits. Of course, bank deposit is avoidable. Have little money, emergency fund so that it is accessible. And then maybe the hybrids, because hybrids are also proving to be, a very good vehicle. Simple thing is that a good part of your investment in a hybrid fund is invested in fixed income. But the whole thing gets treated as equity if it is 75% hybrid or, those balanced advantage funds and things like that. So if you carefully choose some of those, you are getting fixed income exposure and they're getting the tax treatment of equity.
All right, so to sum it up, FDs, while they are safe and familiar, but debt funds, if chosen wisely, they can offer you better tax efficiency, better returns, and liquidity. So, Dhirendra, moving on to the viewer's question now. Mukesh has sent in this question. He says, I'm 55 years old and have taken early retirement. My son's education is likely to finish this year, and my daughter will get married this year. I don't have a home loan or any other liability. I've accumulated approximately 2.5 crore rupees of savings, including EPF, and around 2.5 crore rupees in my company stocks. So please advise how I should invest this amount to get a regular income of around 1 lakh rupees per month. I want the remaining amount to keep growing, and my return expectation is somewhere between 9 to 12% CAGR.
I would say that, he should seriously consider. One is that it requires careful planning. Things look reasonably sorted in terms of, if there's no liability and only one big expense coming his way. 1 lakh rupee on a capital of 5 crore rupee is is not a very significant amount. Mm-hmm. So with that in mind, I would say that he should still go for, aggressive hybrid fund plus MIP plus senior citizen. Oh, he may not be eligible for senior citizen savings scheme, still 55. But mixing it up and having a 75%, 25% allocation and mounting a 1 lakh rupee withdrawal plan. And he should be careful about one thing, that his accumulation of 2.5 crore into employee provident fund will become taxable because the moment you are out of job, the moment the contribution stops coming in within 6 months, it becomes taxable. So he should urgently move his money from EPF to this hybrid funds, and from there, maybe 1 or 2 hybrid funds, and set up a 50,000 rupee SWP from each and keep rest of his plans, just as it is.
Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.